I am joined by personal finance content creator Cameron, or Kaza, Smith. Today, we are talking about the cost of living and what this actually means.
So what you tend to find somebody like that is they're paying for train tickets, which they may have set a cap on in terms of how fast they can go up in price, but they've gone up in price. They're putting fuel in their car, which has gone up in price. They're buying food, which has gone up in price. You know, everything that they're kind of doing in order to function is increasing in price. I wasn't prepared for anything that I'd be getting into when I left university, and you really are just thrown in the deep end to kind of work it out for yourself. I didn't want to move back home with my parents.
Okay.
I was earning an income. I wanted to start renting. Okay, what now? You realize that this isn't an isolated issue. I'm not the only person that doesn't know about this stuff.
What can people do in this situation?
There are 4 things that I would tell them to do in order to get them on the right track and build their confidence.
Hello everyone, and welcome to the Bank of England's Money Matters podcast. My name is Jamilla and I will be your host. Today we are talking about the cost of living and what this actually means. We're also going to be discussing what people are experiencing and how inflation is impacting them differently. Today I am joined by personal finance content creator Cameron, or Kaza, Smith. And we're going to chat about Cam's experiences and what people in his audience are experiencing at the moment. So, Cam, welcome to the Bank of England.
Thank you.
Welcome to the Money Matters podcast.
Excited to be here.
So, to kick off, tell us a bit about you and your background before you were a personal finance content creator.
Yeah, so I started back in January 2021 while I was still at university. I was studying for a master's degree in electronic engineering. And this was around a time, you know, during the COVID pandemic where all you could really do was play sport and study. So I had a lot of free time. And basically, I started creating content about the academic system, about life at college, university, going on later to post-university when you start working in the real world. And I built quite a large community around people that were interested in that kind of stuff. But what you start to realize, especially what I realized as I neared the end of my university career, is that the academic system doesn't prepare you for what's actually waiting for you on the other side when you leave the academic system. It teaches you how to pass exams, you know, all that kind of stuff. But when it comes to taxes, savings, pensions, credit, how to buy a house, nothing. You're not really prepared for what's really waiting for you on the other side. So I took it upon myself to fill this knowledge gap that the academic system leaves, and along the way create content that's more accessible and digestible for people like me, something that I wish I was receiving when I was at university or even younger. And really it's just snowballed since then. I've been doing it for 5 years now. I recently left my job as a cybersecurity consultant and a software engineer. Which I was doing for 5 years alongside this. And really it's just snowballed massively because I think people are waking up to the power of social media as a channel for educating people, especially around personal finances, which is so important to everyday life.
So what did you personally struggle with in this kind of age from 18 to 24?
So yeah, as I said, I wasn't prepared for anything that I'd be getting into when I left university, and you really are just thrown in the deep end to kind of work it out for yourself.
And was there anything specific?
Well, first of all, I didn't want to move back home with my parents.
Okay.
I was earning an income. I wanted to start renting. Okay, what now? You know, I'm not taught about the taxes I'm going to be paying. I'm not taught about how I'm going to be repaying my student loan. I'm not taught about how to rent or anything like that. Workplace pensions. What do I do with all this money that I've got? I want things, but how do I actually facilitate getting those things?
Okay.
So those are the kind of things that I was experiencing straight off the bat. But also when I was kind of engaging with my peers at my graduate scheme, for example, you realize that this isn't an isolated issue. I'm not the only person that doesn't know about this stuff. And a great example, bringing up workplace pensions, is no one really understood how they work. So I found that I was having these conversations with my peers and people were opting out of their workplace pensions purely because they didn't understand the long-term benefits of them or how they worked. And in their head, it was just reducing their income short-term. And I think that's a crying shame because they're so important for long-term, you know, financial stability.
Okay, so we're talking about the cost of living and what does this actually mean? So this is looking at how the prices of everyday things, rent, food, travel, people's bills, compared to people's wages. Why do people experience the cost of living differently?
So there's a few ways. So first of all, I think it's important to acknowledge that the rate of inflation, which is currently 3.2%, is based on how the price of a basket of goods has increased in price. So that basket of goods is filled with, I believe, 754 different products and services that the average person might buy. And your products and services that you buy might be different from those 750. That's a lot of things to buy, products and services wise.
Absolutely.
So technically, that may be the rate of inflation, but it might not be your rate of inflation. So that's why personally I use this tool by the ONS called the ONS Personal Inflation Rate Calculator, and it basically allows you to select what products and services you do and don't buy, and off the back of that, it will give you an estimate of what your personal inflation rate is.
I think then it's important to recognise that slowing inflation, which we're seeing at the moment, doesn't mean that prices are going to go down. So sometimes people think that these are kind of...
Well, exactly. So just because the rate of inflation dropped from 3.4% to 3.2% doesn't mean prices are going down, as you just said. It means that the rate at which they're rising has slowed down. They've slowed down by 0.2% in rate. So that's a common misconception because people might go to the shop and they've heard that the rate of inflation's gone down. Well, why are prices still going up then?
So when you say it's 0.2%, people won't actually feel that then, because if it's the 0.2% of the rate, it's not 0.2% of the price, it's just the rate. So it's still going up.
Hardly,
just
exactly.
Slightly more slowly than previously.
Well, I mean, the Bank of England set that 2% target, don't they? And we've seen rates of high as 11% in the last 5 years. So I'm sure people started to notice when it was the difference between 2% and 11%. But between 3.4 and 3.2, it's going to be hardly a difference. But hopefully when we get that rate back down to that 2% target, hopefully prices will start to, even out a little bit.
I think it's important to talk about actually the difference between inflation rate and the bank rate that the bank set. Because the bank rate is set as a way of controlling inflation. So the inflation target is 2% and the bank rate is used to control that because it impacts how much people spend and borrow in the economy, which impacts how much prices go up. So they're actually different things. And I think sometimes people get confused about that as well.
No, definitely. And I think a lot of people might wonder as well, why do we set a target for inflation? Why do we want prices to go up by 2%?
Yeah.
Why don't we want 0% inflation? It's quite an economically fueled answer to that question, but it's essentially because the Bank of England are trying to avoid deflation. We don't want prices to come down because that's going to have a whole load of knock-on effects with productivity, with companies hiring staff, with employability, all these kind of measures that we don't have time to get into right now. But that's often a question I get as to why is 2% the target? Why can't we do better, get it to 1%, 0%? But it's because we're trying to avoid that deflation.
Makes sense. And I also think it's important, we hear a lot, we have citizens panels and agents across the UK that are listening to people and how they're feeling, which helps us inform us as the Bank of England, inform decisions. And I think a lot of people kind of don't understand sometimes why people experience inflation differently. And you've talked about the basket of goods, and everybody's basket of goods are different. Some people will be buying TVs, some people will be buying bananas. So it's different for everybody. But there's also the fact that it's an average over the past 12 months. Can you explain that?
Yeah, that's a really good point. So yeah, the rate of inflation at 3.2% number that it currently is based on what inflation was like between this point and this point 12 months ago. It's basically like a sliding window. So that's the result. Basically, well, the reason why that's, I guess, confusing is because, as I mentioned, we've had inflation rates of up to 11%, but that 3.2% metric doesn't consider that because it's out of that 12-month sliding window. So what you find is people are wondering how have prices increased. Some people are saying that prices are doubling in like price. Some products are doubling in price, but inflation's only 3.2%. How does that make any sense? Well, it's because it's completely not factoring in the other 5 years. I'm sure if we extended that 12-month window and looked over inflation over 5 years, you'd see a bigger number than 3.2%.
And even if we were looking at 13 months, there may have been a massive peak, and then that's not taken into account at all on the average.
Of course not, no.
People will see things differently as well because obviously prices are sticky. Let's talk about this concept of sticky prices and the difference between some things like food. We'll see going up straight away. I'm seeing the price of Freddo's going up the whole time. And other products, if you just go to the supermarket, suddenly it can be 20p more than it was last week. Whereas things like insurance, so car insurance, rent, that won't go up by £20 a week. So what is the difference?
Well, I guess inflation just affects variable costs and fixed costs a lot differently. Usually a cost is fixed because it's under a contract, whether you've got a fixed rate mortgage, a fixed term contract on your rent, or a fixed insurance policy that's over the 12-month period. Those things aren't going to be immediately affected by the rate of inflation the same way things like petrol, food, the cost of a taxi, even a plane ticket to another country. These are things that are going to experience the rate of inflation almost immediately because of how these things are essentially provided. So for example, food, it has to be exported. It has to be, whether it's by boat or by van or by plane. These things all cost fuel. Whether it's your plane ticket, it needs fuel to go into the plane. So if the cost of fuel's gone up, your plane ticket's going to go up in price. So that's the difference. That's why you find that there are these sticky prices where things go up in price really quick. Some go up a lot slower. So a great example is that the car insurance. People saw the rates of car insurance skyrocket, I believe, in the last year or so. And that was just because the cost of insuring a car has gone up, because if your car is damaged and you need to repair it, well, the cost of the products and the services that you're getting to actually fix that car and provide the insurance has gone up in price.
So people 18 to 24, they're in very, very different situations. Some people at university, some people are potentially buying their first home. Let's talk about how they're experiencing those costs differently. So from your audience and your experience, what are people, let's say somebody who's left university, they haven't been able to get a job and they're still living with their parents, what are the biggest pressures going to be for them?
Well, yeah, so someone like that, young people especially, have a lot less fixed costs because they don't have mortgages. They're renters, which tends to be an annual contract. They're buying food. They're buying for petrol in their car. So they have a lot less fixed costs. So the rate of inflation is something that's pretty much experienced almost immediately when it goes up. So for example, you bring up somebody who's living at home with their parents. They're not paying for a mortgage. They may be contributing to household bills and stuff like that, but they're not under fixed term contracts on those costs. So what you tend to find somebody like that is they're paying for train tickets, which they may have set a cap on in terms of how fast they can go up in price, but they've gone up in price. They're putting fuel in their car, which has gone up in price. They're buying food, which has gone up in price. Everything that they're kind of doing in order to function is increasing in price, which I can imagine is really frustrating when you feel like these are meant to be the prime years of your life. You're meant to be climbing the career ladder. You're meant to be buying your first home, starting a family, but you feel like there's that friction that's just holding you back a bit. And it's usually because everything's just so expensive now. You have to be very frugal. You have to be, very considerate of the decisions you make. Everything feels like a really big deal. Whereas I can imagine if you're comparing yourself to what our parents were doing in their 20s, it was a lot less, I guess, difficult.
Definitely. My mum bought her first home at 21, and I've not bought my first home at 21.
It's not easy anymore. No, not to say it was easy back then, but when you look at the data, the cost of homes versus the average salary has gone through the roof. It's completely disproportionate. So yeah, it's not easy, and you're not alone by not buying your first home at 21.
And I think it's really important that we bring out these kind of travel costs and food costs because they do move so quickly. And we've kind of talked about that, but I think it's the fact that it's not only impacted by inflation, but also supply and demand. So for things like food, if something happens elsewhere in the world and there's just not enough food, the price of food will go up. If there's not enough supply, the companies will put the price up.
Exactly. The Bank of England does do a lot in order to influence the rate of inflation, but it doesn't control every aspect of that inflation rate. And there are external factors, whether that be global, whether that be through supply chains, that do affect the cost of things. So for example, if there's a poor harvest in another country where we get a certain product from, for example, wheat, then you're going to find that the cost of bread will go up. Or, when we export our fuel or our crude oils and our gases from other countries, and perhaps there's an issue with the supply chains or the travel routes, you're going to see an increase in price. So that's something that you're seeing currently with over the last 5 years with everything going on with Ukraine and obviously Iran most recently.
And I think, we won't get into the details of this because we haven't got time, but also market reaction to these sorts of things. So sometimes for petrol, prices can shoot up because people expect there to be an issue or suddenly a short supply. So prices can change so quickly, which makes it tricky for young people because how are you meant to budget £40 to fill up your car with petrol and suddenly you get there and it's £50? I think that's a real challenge.
It's a real issue, and unfortunately there's not a lot you can do about it. But there are some things you can do, but we'll get into that later.
You made a really good point earlier that actually a lot of these things going on that are affecting people through the cost of living are actually very much out of their control. And it's much bigger external things going on that are having an impact on real life people every day. What can people do in this situation?
So yeah, it's a really good question. What can you do?
Please answer it for us.
and I think I've had this conversation quite a lot, and I speak to basically, let's put it this way. If I'm talking to somebody that has absolutely no idea what to do with their finances, they're basically starting from square one. There are 4 things that I would tell them to do in order to get them on the right track and build their confidence. So we'll start with number 1. So number 1 is engage with your finances. You need to know how much money you've got coming in, what you're spending that money on, and what you're working with here. Because if you're completely blind to your personal financial situation, what you've got coming in, what you've got coming out, how can you expect to make any decision with any information? You've got nothing. You're flying blind, basically. And once you have that numbers, once you have this laid out, whether that be on a scrap piece of paper or a spreadsheet on Excel, whatever it is, set a financial goal. What do you actually want to achieve, whether it be in the short term, the short term or the long term? Do you want to save up for a new car? Do you want to, buy your first house? Do you want to move out of your parents and start renting? Set a financial goal so you actually know what you're aiming for, because if you don't have a target that you're trying to reach, you're just going to float around. You don't have an actual direction to head in. So that'd be the first thing I would say. Then there's number 2. So next, I would look at ways that I can reduce my outgoings, reduce how much you're spending. There are so many ways you can do that. Obviously, the easiest way is to just cut back on things you don't need. Is it that subscription that you're not using anymore? Are you not going to the gym despite paying £40 a month for a gym membership? I've been there. I know what it's like. That's an easy way to reduce your spending. Cut out the stuff that's not serving you anymore. It's really easy. It could be coffees, gym memberships, subscriptions, whatever it is. Reduce your outgoings in any way you can. But there's actually other ways you can reduce your spending other than cutting out the things you like. And that's through using things like discount codes, vouchers, even cashback cards. There are some credit cards that offer you cashback. As long as you use it responsibly and you pay off the balance in full and on time each month, they can be helpful in essentially reducing your expenditure by giving you cashback. Number 3, so now that you've reduced your spending, your outgoings in any way you can, the second easiest thing you can do to improve your financial situation is to try and earn more money. So the most straightforward way to do that is to try and progress in your career. That's something that I did, is by pushing for promotions, job hopping to other companies or other industries in order to progress your salary and earn more money. That's the most straightforward, most straight and narrow way to start earning more money in your life and improve your financial circumstances. But you don't only have to make money from your 9 to 5. If you have skills, hobbies, interests, there are ways that you can monetize that. So for example, personally, I had an interest in creating content. At the time, it was about the academic system, but that later progressed into personal finance and talking about stuff like that. That is a way that you can monetize your skills and habits. So there's other ways you can make money, but it's definitely the second easiest way to improve your financial circumstances. Then the final one, and I'd say that this is the most important step, you need to educate yourself around personal finances. You need to engage in this topic area, because the more you know about saving, investing, credit, general money mindset, the more confident you can be to make financial decisions in your own life. And as well, you can engage more in economics and potentially a little bit of politics. So you can understand how the decisions that places like the Bank of England make affect you personally. So instead of you being at the whim of decisions that these huge institutions that have been around for hundreds of years make for you, you can actually understand what they mean for you, and you can make decisions with more confidence off the back of this and engage more with your finances.
Those are really helpful tips. Thanks so much, Cam. Before we close, let's see how you got on with Tom on the quick fire round.
May I extend the warmest of welcomes back to the bank, Cam. I'm Tom, official quizmaster. I'll let you in on a secret, Cam. To curate your bespoke quizzes, your questions for today, I may have had a bit of a stalk of your socials.
Oh no.
And I was shocked to discover that not only is it very informative, very high quality content, great job.
Oh, thank you.
You also love a great quiz. I mean, you've posed questions to the Chancellor, to the Prime Minister, our very own Governor, would you believe?
You know me too well, Tom.
I certainly do. I certainly do. Are you prepared for the rapid fire multiple choice quiz question round?
I think I might be too prepared.
Are you sure? That's some real certainty.
I am certain.
We'll begin. Monetary policy is action that a country's central bank or government can take to do what? A. Ensure the country's financial system is resilient to any risks and shocks. B. Stimulate economic growth via the use of taxes and spending. Or C. Influence how much money is in the economy and how much it costs to borrow in order to influence inflation.
The answer is C.
Correct. The answer is C. Come on, I can see the Zen mode already on your face.
Just want to make it clear.
Yeah, okay. All right. In what year was the Bank of England granted operational independence from the government over monetary policy? Was it A, 1945, B, 1997, or C, 2020?
B, 1997.
Correct. And this is very important to us because our operational independence means we can look into the long term in our efforts to keep inflation low and keep maintaining a stable financial system. But although we're independent from the elected UK government, we're certainly not independent from the people of the UK. We serve the people and are accountable to the people of this country. True or false? If inflation falls, that means prices are going down.
False.
Correct. In order to help control the rate of inflation, the Bank of England is able to A. Impose price caps on supermarkets to keep costs low. B. Subsidise import costs for businesses to make goods less expensive. Or C. Increase the base rate of interest to reduce overall spending in the economy.
C.
Correct. I can start to see some beads of sweat emerge on your brow there, my friend.
It's an imagination.
Oh, okay. The members of the bank's Monetary Policy Committee vote on whether the base rate of interest is reduced, kept the same, or increased. In the event of a tie, who casts the deciding vote? Is it A, all bank staff who vote in an internal referendum, B, the governor, or C, a retired fortune-telling octopus?
Ooh.
It's a tough one for you.
The fortune B. The answer
Correct.
is B.
True or false, it can take up to 6 weeks for a change in the base rate of interest to fully affect inflation rates.
False.
Correct, it can take around 18 to 24 months for monetary policy to have its full effect on the economy. Which of the following were not included in the 2025 basket of goods and services used by the Office for National Statistics to help calculate the rate of inflation in the UK? A. Marriage licences. B. Replica football team shirts. Or C. Second-hand electric cars.
A.
Incorrect. It's second-hand electric cars. But you're on a good streak there.
Shocking.
You're on a good streak. Don't let me psych you
Marriage
out.
certificates.
Marriage certificates. It's in
Never
there.
bought one in my life.
Well, hopefully if you do, it's your only one. Which of the following scenarios could affect inflation rates? A. A major sale starts at a large department store. B. Bad weather damages harvests. Or C. Your mate decides to sell their entire wardrobe.
B.
Correct. True or false? The Bank of England can set specific prices for common goods and services.
False.
Correct. The bank can only influence the overall rate of inflation through its monetary policy toolkit. True or false? I'm going to go nice and slow on this one, okay?
Thank you.
Pay attention. I know you got this.
I'm paying.
Zen mode, okay? The price level is the speed at which prices increase over the last year, while the inflation rate is the average cost of goods and services in the economy at a specific point in time. True or false?
False.
Correct, it's the opposite way around. In which country was the highest rate of hyperinflation ever recorded? Was it A, Hungary, B, Zimbabwe, or C, Germany?
Ooh. It's between B and C, but I'm going to go with B, Zimbabwe.
You're locking that in.
I'm locking it in.
It's your final answer.
Final answer.
Incorrect.
Oh!
It's A, Hungary, in July 1946.
I need to reread my histories.
You do. Well, you're going to love this one. At the very peak of Hungary's hyperinflation crisis in 1946, how much time did it take for prices to double? Was it A, 3.5 hours, B, 15 hours, or C, 36 hours?
Wow, not much to work with there. I think hyperinflation would imply, let's go with A, 3 hours.
Incorrect. It's B, 15 hours.
How did you know I knew nothing about Hungary?
You know, in case that wasn't hard enough, we're about to get even harder, okay? Hope you've brushed up on your economics. The economic metric that can be used to compare the price level between different countries is known as what? A, purchasing power parity, B, the consumer price index, or C, the money usefulness comparator?
C, the money usefulness comparator.
Incorrect. I'm so sorry. It's A, purchasing power parity. And just in case that wasn't hard enough,
Yeah,
you know,
more,
I thought
more economics.
Yeah,
please.
I'm going easy on you today. This one is really hard. In economics, the concept that measures how much individuals are likely to spend rather than save out of an increase in their income is known as what? A, marginal propensity to consume. B, the general equilibrium theory. Oh, I thought, look on your face. It's worth £1 million. Or C, the monetary transmission mechanism.
I want to say A.
Is that your final answer?
Yes.
Correct! There you go. Cam, we're on to the final question. It's the wild card, the trivia question about the bank. I'll warn you, nobody so far has gotten this correct. Will you be our
It's
first?
always the first, and it will be me.
What was the original name of Bank Underground Station before it was renamed in 1940? Was it A, Central, B, City, or C, Cornhill?
A, Central.
Is that your final answer?
Yes.
It's incorrect. It's B, City, hence the Waterloo and City line.
See, I thought you would say, hence, the Central Line.
Oh.
You see?
Unfortunately, the Central Line was built about 50 years beforehand. But no, the Waterloo and City line, the two stops. One's Waterloo, the other one was City.
I just want to caveat, I wasn't there, so
You weren't there at the time.
I wouldn't
How
know
could
this.
you have
How could I
possibly
possibly
known?
have known?
Now it's time. Kazza time for the scores on the doors. I must warn you, you're up against some very stiff competition. Our previous guest, Fis, walked away with 12 points correct. That's a very impressive score. It's 80%.
Very
Okay.
impressive.
How do you think you did?
If I can count to 15, I don't think I did as well.
You don't. I can now reveal you did it with 10 correct answers. You are officially second on our leaderboard of 2 people.
The first loser. Is that what you're telling me?
Well, look, it's a tough gig, okay? Fis she was trained professional, 10
You know
years
what?
industry
No.
experience.
Hungary. You've done this to me.
You were pipped at the post, but you might cling to the silver medal. So best of luck. You'll need it for next month.
Thank you, Tom.
Cam, it's a pleasure.
Pleasure as always.
Thanks for coming.
Well done. That was tough. You did a great job.
I'm going to have to revise my Hungary history.
And so am I. Okay, so my final question. If you had one message to people, anybody that is struggling at the moment, what would it be?
I would say, give yourself an unfair advantage. Actively engage in your personal finances. Teach yourself the things that the academic didn't and won't teach you. Fill that knowledge gap around saving, investing, credit, things that you need in order to function in this economy and be successful ultimately. Because the more tools, knowledge, and skills that you have, the more confident you're going to be with your money and the better you're going to be at making financial decisions.
Thank you so much for sharing that. And thank you for joining us today.
Thank you for having me. It's been a pleasure.
It's been great to have you. Thank you so much.